And the fourth is understanding Benjamin Graham's Mr. Market. So let's get started. Okay, so you might be wondering why we're starting off so basic with what is a stock market, since a lot of people understand that. But what I'd like to stress is that before we can master something, we have to first start with the fundamentals. So let's go ahead and start off with our fundamentals and really just kind of put this out here. And I think you're going to see how fast things compound as we start talking about more advanced things after we first understand what the stock market is. So on the left I have a picture of a little boy and his mother buying some fruit at a local market, and on the right I have an old-time photo of the stock market, New York Stock Exchange. And you can see on the left, this is a market where people trade money for food, and on the right, this is a market where people trade money for a proportional ownership of a real company or a stock. So let's go to the boy and his mother picking the fruit. In this scenario, let's say that this little boy is going to go up and he's going to buy this peach from a vendor. As he walks up, he asks the vendor, how much is the peach for one peach? And the vendor replies, let's just say $1. And so at that point, if the little boy decides to buy the peach for $1, the market price for that peach was determined by who? Was it determined by the vendor selling the peach, or was it determined by the boy? And to answer that question, it was actually determined by both of them, because the little boy had to agree to the price that the vendor was asking. And so when you understand that the value of something is only what people are willing to buy and sell it and meet in the middle, you can start understanding how markets really work. And so how would the price of that peach change if we changed the sellers? Let's say we had more sellers. Let's say that we had 5 different peach vendors all lined up next to each other, and we still had the same number of consumers, which would be the little boy and his mother here, and each vendor wanted to sell their peach. Well, the more vendors that we have all selling the same product, the little boy now has the option to say, well, you wanted $1, but the person over here only wanted 90 cents, so can you beat their price? And so then what you get is you get competition amongst the sellers or the vendors, and the little boy is the person who's really kind of controlling the price as the buyer. Now, if we take that scenario and we'd flip it on its head, and let's assume that there's only one peach vendor, one peach seller, and there's 100 little boys all wanting to buy a peach, that vendor, the seller, now has the ability to control the price of that peach. And this is what we call a buyer's market versus a seller's market. And so when we look at the stock market, we have the exact same thing happening as that scenario that I just described. You have buyers and sellers. When the sellers outnumber the buyers, that's called a buyer's market. And when you have the sellers are less than the buyers, that's called a seller's market. And the reason it's considered that is because in that last scenario where there's less sellers than buyers, the sellers are changing that value of the company, the value of the shares. And that's something that you just really got to understand, because it's really fundamental to how the markets move. So let's take this with one share and one seller. To break this down, and you can see how the stock market's really working, and how eventually that market price that you see when you go look up a company and it says the market price is $65, this is what's happening. This is what's determining that market price. So let's start off with a seller. Her name's Amy, and she has one share of J&J, which is Johnson & Johnson, and she wants to sell her share for $65. Okay? So what she's going to do, and she has the option to she's going to work with a broker, and you can see that I have the bank there as the broker. But this could be Scottrade, this could be E-Trade. Any of those brokers could broker this deal for her. And what that really means is that the broker is going to link up a seller and a buyer, and they're going to exchange their asset. So when Amy does this and she's going to sell her one share, she has the ability to put it on the market for one day for her $65 that she wants, or she could set it up for a 30-day trade, meaning that she has 30 days to find somebody that will buy her share for $65. Now, the first type of order that we're going to talk about is what's called a stop order. And this is when somebody is willing to buy it for $65, then the trade would be executed. So she says, broker, you're not allowed to trade my one share unless somebody out there is willing to buy it for $65. Whenever Amy, let's assume for just 1 second that Amy had 100 shares, okay, and she wanted to sell all 100 shares, and she put in a stop order at $65, meaning some buyer has to at least be willing to buy the first share for $65. Whenever that happens, Let's say that the first buyer only wanted to buy 10 shares at $65, and then the next buyer wanted to buy the remaining 90 shares, but they were only willing to buy it for $64.90. Amy's shares would all be executed under that stop order, and that's the thing you got to really understand about a stop order is even though she has it set for 65, if not all the shares are executed in that first order, the second order, whatever the price, it could be higher or lower, is going to be executed because it's all done at once. So that's the one thing you got to be aware of with a stop order is even though it's at 65, if not all the shares are executed at that price, some of them could go lower or higher. So let's go to the next thing here. So we know that Amy's wanting to sell her one share for $65. Now we have a buyer. We have a guy named Trevor, and he wants to buy a share of Johnson & Johnson. And so he puts in a stop order for $64. Okay? Amy's trying to sell her one share for $65 because she wants to make more money on it. But Trevor doesn't necessarily want to buy one share for that high of a price, and he's putting in a stop order for $64. Okay, so let's see what happens. So as you can see here, the arrow pointing to where Amy's willing to sell her share is 65, and Trevor's only willing to buy it for 64. So we have a discrepancy here. And if we assume that every single seller on the market would want to sell their shares for 65 and every single buyer would only be willing to buy it for 64, you would see no trades happen on this particular stock. So the thing you got to understand is for every transaction, every single transaction, the buyer and the seller both have to agree on what the price is going to be in order for that trade to occur and for that market price to even show up. So let's assume that Amy and Trevor stick to their stop order, and she keeps hers at 65, he keeps his at 64, and then all of a sudden we have this person entering, Kurt. Okay, and Kurt owns one share of Johnson & Johnson, and he's listed over there on the seller side with Amy. And instead of putting in a stop order, he puts in what's called a market order. And what that means is Kurt's basically saying, hey, any buyer out there that's willing to buy my one share of Johnson & Johnson, whatever you're willing to buy it for, I'll sell it to you. That's what that means when he puts in a market order. Okay? And since Kurt does that, Kurt comes into this equation, the trade is executed between Kurt and Trevor for $64. And now, meanwhile, Amy's still sitting there at $65 wanting to sell her share for $65. And so that buyer that was out there was met up with Kurt because Kurt didn't care what price he could sell it for. He just said, I'll sell it for anybody out there that's willing to buy it, and Trevor happened to be that person. So the market price now, if we were going to go pull up Johnson & Johnson and this was the only trade that happened for the day, the market price would now be displayed as $64 a share. Now let's look at this from the opposite perspective. Let's say that Amy is the only seller out there and she's offering to sell her one share. And Trevor's a buyer, and now we have Linda who's a buyer. Okay, Trevor has the stop order in for $64, which is not the price that Amy's willing to sell the share for. But now Linda comes along and she puts in a market order. So Linda's like, I don't care what price I can buy this at. Whatever seller is willing to sell it to me for, that's what I'll buy it for. And so Linda then executes the share at $65, and now the market price moves to $65. And both of these sellers have now executed their shares. Kurt sold his to Trevor, and now Amy sold hers to Linda. During that cycle right there where we saw two shares traded, we saw the market price go from $64 to $65. Okay, does this mean that the company is worth $65 a share? Or did a couple of people trade it for $65 and that was nothing more than the trading price? And a person like myself and a lot of other value investors would obviously argue the second one, is that was just a price that a couple people established. But when you look at the grand scheme of things and how many owners are out there that aren't trading their shares, you'd have to come to the conclusion that they disagree with that market price, or they'd be selling their shares or buying their shares. So the thing to really take away as we look at this scenario is just because something's trading for $65 a share by a couple people doesn't necessarily mean that the company is actually worth $65 a share. And that's what value vesting's all about, is actually determining what is that share worth and then looking at what people are willing to sell it for or to buy it for and capitalizing on that. So let me show you what a limit order is. So what we just talked about was a stop order. Now a limit order is that, let's go back to Amy, and she wants to still sell her, let's start over again. Amy wants to sell her share for $65 or better. So if the price is $65, she's going to sell it. If the price is $65.10, she wants to sell it. So as long as that price is higher than the $65, Amy wants to sell her share. Now we have Trevor, who wants to buy one share, and he puts in a limit order for $64, meaning if he's going to buy it, it has to be under $64. He's not paying a penny more than $64 whenever he buys one share of Johnson & Johnson. So now as we look at this chart, it's not just pinpointed on the 65 and 64. You can see for Amy, it's 65 or greater, and for Trevor, it's 64 or less. So in this scenario, if this was the only seller and the only buyer of that one share, you would see no trades executed because there's a discrepancy and they can't agree on the price. So here we go. Once again, Kurt enters and he puts in a market order. And so because Kurt's willing to sell his share for pretty much anything, that whatever the buyer offers is what Kurt will sell it for. We got the market price is now displayed as $64. So here's what I want you to really understand. For every single trade that happens, there's always a seller and there's always a buyer. So if you're buying shares from somebody, somebody's wanting to sell those to you. And their reason for selling them might be Amy's reason for selling. So for Amy, she said, this stock stinks, I can't make any money off of it, so I'm going to sell it. And so whenever she sold that share over to Linda, if you remember in the first scenario, Linda was buying it because this company's going to make a lot of money. So here you have two people that traded an asset, traded that share. One of them thinks that it's a piece of junk, and the other person thinks that it's a great company, it's going to make a lot of money. And then as you looked at Kurt, he was selling it because he needed money. So he might have still felt like the company was a good company, but he sold it because he needed the money. And then Trevor, he's buying it because he thinks it's going to make money. So the thing you got to look at, when you look at the seller's perspective, it could be really twofold. The person could be selling it because they think it's a horrible asset, or they could be selling it because they just generally need money. On the buyer side of the house, people are only buying shares because they think it's a good company, it's going to make more money for them. So as we look at that scenario a bit on a grand scale, hundreds of thousands of people doing that for any stock, you can see how that market price is moving up and down because it's not the majority of people that are determining that market price. It's just a few people that are determining that market price. And so what you see is it's going up and down because people don't want to sell their shares for any less than what they could make off of it, and people don't want to buy their shares for any more than what they have to pay for it. And so what you find is that the market moves in these cycles. And so this was Benjamin Graham's big thing. And if you don't know who Benjamin Graham is, this was Warren Buffett's professor at Columbia, and he attributes almost all of his investing knowledge to Benjamin Graham and his principles. And one of the things that Benjamin Graham taught in his class at Columbia was this idea of Mr. Market. And so he described Mr. Market as his emotionally disturbed business partner. And you can't change Mr. Market's behavior. All you can do is react to it. And so the saying goes, Mr. Market is your servant, not your guide. So the way that Benjamin Graham would describe this in his class is he said, Mr. Market might come out and say, hey guys, hey everyone come here, buy stocks. You can make a lot of money. You can do great today. And he creates all this hoopla and emotion behind the market. And he's telling everybody, not only am I making tons of money, but my neighbor's making tons of money. And then Mr. Market can also be the guy who's just got a horrible attitude on the direction things are going. Watch out, I'll take all your money. And the outlook for tomorrow is even worse than today, so don't even ask. And if you really think you're going to make money in the stock market, you're just kidding yourself. And so these were the personalities that Mr. Market had. And what Benjamin Graham wanted his students to really understand was you never follow Mr. Market's emotions. Mr. Market's fooling you. What you have to do is you have to go in there and you have to look at what Mr. Market is offering you, and you have to remain calm and competent. You have to figure out what the company's worth and not get wrapped up in the emotion that's behind Mr. Market and the things that he creates. And so that's where the saying comes from Warren Buffett, where Mr. Market is your servant because he's providing you either really good deals or he's providing you really crappy deals. And he's not your guide. So you don't follow his emotion. You you capitalize off of what he's doing. And so that's the thing that you really got to take away from this lesson is the market is sometimes going to give you great deals and you got to take them, and other times the market's going to give you horrible deals and you can't be fooled by the emotion of everybody else, and you have to be able to determine what the value of a stock really is. So that concludes lesson 1 from unit 3, and the first lesson objective is what is a stock? The second is how does the stock market work? The third is what is a limit order and a stop order? And the fourth is understanding Benjamin Graham's Mr. Market. So we'll see you in the next lesson.